In today's video, I'm going to cover 9 ADU financing strategies, and we will start with the least desirable ones, 5 of them, and we will move forward to the better options, and we will close the video with the big news of 2024. So stay tuned till the end. Okay, welcome everyone to Personal Finance Night. At Personal Finance Night, we talk about everything related to money, investing, building wealth, and protecting assets. The channel is geared towards real estate, so in today's show, we're going to talk about a real estate topic, financing ADUs. Okay, so like I said in the intro, there are 5 least desirable options, but they really make sense in certain circumstances. Number 1 is cash. Okay, why I don't really like cash? First of all, not everybody has access to large amounts of cash. Second, I really like OPM, other people's money. Okay, so we have to find the right capital structure between how much debt we have on our properties and how much capital we put in our properties, or how much equity, right? Okay, number 2, it's unsecured personal loans and credit card debt. Okay, unsecured personal loans, I really don't like it because first, usually they have higher interest rates, and you're capped at 100K in general. Okay, my market is Southern California. There's no way I can build an ADU with 100K. Okay, detached ADU at least. Maybe we can convert a garage for 100K. But anyways, I don't. It's an option. It's out there. So if someone doesn't have cannot access the other options I'm going to talk about, this is a valid one, and they should definitely pursue it because ADUs are really a great investment. Okay, and the credit cards, you can't really finance all of your ADU project with credit card debt, but I did use it in the past for during my first remodel. I applied for a 15 months interest-free credit card, and I put all the material on it because you go to Home Depot, you pay with a credit card. You cannot really pay your contractor with credit card. Some do accept those, but they charge a fee. So that's what I did, but you can't really finance all of your ADU project with credit card debt, okay? But you have to use it wisely. You have to be able to You have to have a plan, and I did have a plan when I used my credit card, a plan to pay it off, okay? So I was comfortable putting a lot of debt on my credit card. My score dinged at that time, but I didn't have other things going on that I didn't really needed my credit for other investments at that time. So I was okay with it. Okay, number 3, it is family and friends, which is private money. Okay, this is not a bad one, but you gotta keep your promise. You gotta keep your promise and pay back your friends and your family members on time and on term, even earlier than what was the agreement you discussed with them. Okay, make sure you keep the relationship. If you feel that this is not for you, then it's definitely not for you. Move to another option. Okay, now number 4, it is cash out refi or cash out refinancing. This had its place in the past and was a very good option, okay, but not anymore. The reason why: most of us have really low interest rates on our primary mortgage. So if you the cash out refi, you would have to, like the name says, you would have to refinance your primary mortgage and tap into your equity in the form of cash out, the cash that you're going to use to build your ADU, but then you will have a new loan, a completely new loan with no interest rate. In today's interest rate markets, and most of us have less than 4, less than 3%, even primary mortgage rate. This does not make sense, but it was a valuable option in the past. Now, if you bought your house, your property in 2020, end of 2022, or in 2023, you probably have a high mortgage rate anyway. So this could be a good option for those people, but you still need to have that equity built in. Okay, now number 5, and the last one of the least desirable options for ADU financing, and it is construction loans. Don't get me wrong, it's a very valid option, but right now it's not the best time for these type types of loans and ADU financing. The reason is, just like the cash out refi, you would have to refinance your primary mortgage, okay? And we don't want to do that when we have a beautiful 3% primary mortgage interest rate, okay? I personally have 2.75%, so none of the first 5 was an option for me. Now, if you liked what you heard, make sure you subscribe, like the video, and share with family and friends. Okay, let's keep going. So the better options are a home equity mortgage. Now, why is it better? This is also called a second or a secondary mortgage on your property. It's better because you do not touch the primary mortgage. So your primary mortgage stays the same, your 3 or 2.75% in my case. I don't touch that, and I will never touch that, okay? But throughout the years, and thanks to the crazy appreciation that we had recently, we have some equity in our properties, okay? We can take a loan on that equity, and I'm gonna explain the math. So let's say your primary loan balance is 500K right now, but your home value is 900K, okay? That means you have 400K in equity that you're not using, that you can actually use some of it for to take a second loan and finance your ADU. How does the math work? So we're gonna go with the most common LTV or loan to value percentage, which is 80%. That's the most common one, okay? The second mortgage lender is gonna tell you, I'm willing to give you a loan as long as your total debt does not exceed 80% of your appraised home value, which is in our example 900K. What is 80% of 900K? That's $20,000. Now your first mortgage balance is $500,000. What does it mean? Your second mortgage lender can loan you $220,000. That's not bad, okay? So it's 80% total loan to value, okay? Don't confuse it with 80% of the actual equity you have on your property, because your equity is 400K, 80% of that would be $320,000. Now, $320,000 plus the primary mortgage balance of 500K, that's $820,000. $820,000 divided by $900,000 total home value, you are at 91% loan to value. Lenders won't accept that. I mean, there are some that would do that still, but the interest rates will be extremely higher, etc. And you put yourself at risk of, going underwater if there's a correction in the real estate market, okay? So that's the number one really good option for ADU financing, as long as you have equity in your house, in your property. Number two, very, very similar with one small tweak and change. It's called HELOC, Home Equity Line of Credit. Now this one, you do not have to take all of your equity out. You don't have to take it out and start paying interest and mortgage pay down on it. This works exactly like a credit card. If you use it, you pay on it, and you have to pay your minimum payment. If you don't use it, it's there for you, available for you when you need it, when you're ready to start building your ADU, or to start the design and pay the architect and pay the permit fees and pay the contractor. That's when you draw on your HELOC, okay? This is a very good option, and that's what I'm using to build our first ADU, which is, the construction is gonna start. I'm very excited. The construction is gonna start very, very soon, because we're almost done with all the design and the permitting. We're at the very last stages of getting approved. Okay, now number three, this is Renofi. Renofi is a company that I love their product. I'm not affiliated with them. They don't even know me. I don't get compensated from them. But it stands for stands for renovation, and FI stands for financing. So as the name states, they focus on financing renovations, and an ADU is a renovation to your house. Okay, so they can totally finance your ADU. The way it works, it's exactly like the HELOC and like the home equity line of credit. They finance you they take a second position, okay? So you do not touch your first mortgage, which is great. You know, that's why I like this product. You don't touch your first mortgage, and they take second position. They basically issue you a home equity credit or loan that is based on your future value. It's based on the future value of your property after you build the ADU, not on your current value. So HELOCs and home equity line of credit and home equity loans, they give you a loan based on the equity that you currently have on your property. These guys, they base it on your future equity. So they look at, let's say you have a 3-bed, 2-bath, okay? And you wanna build an ADU, 1-bed, 1-bath. Now, when they appraise your property, they're gonna say that you actually have a 4-bed, 3-bath. And they would base all of their appraisal and equity, the same calculation, the same math, the 80% LTV, based on the future value of your house. Isn't it great? I love their product. But again, they don't even know me. I have nothing to do with them. But now let's move on to the really, really good news for 2024. And if you stayed with us all the way till this moment, thank you very much. I appreciate you. Please make sure you subscribe, you hit and smash that like button. Okay, now, Freddie Mac just announced, or they didn't even announce it, it was kind of like low-key. They have submitted a proposal to the FHFA, the Federal Housing Financing Authority, to get approved to enter the second mortgage market. What does this mean? You know, let's talk quickly about how the mortgage industry works. First loan, first mortgage on your home, okay? Your lender, whoever that is, they sell mortgages to many applicants like you that become homeowners or investors, right? Now what they do, they take all of those loans, they package them together, and they sell them on the secondary market. It's called secondary market, okay? Freddie Mac and Fannie Mae are the biggest buyers of those packages. They are called mortgage-backed securities, MBS. Now, because the lender knows that there is a buyer of their loan that is a big one and that is also backed by the government, okay, or highly regulated by the government, there's less risk to them, okay? So the interest, when there is less risk, the interest rate goes down. It's going to be the same thing when this proposal gets approved by the FHFA. It's going to be the same thing for the secondary mortgages that Freddie Mac wants to enter and starts buying on the secondary market. This is great news, guys. If it gets approved, it will help many people tap into that equity at lower interest rates and use that cash to finance their ADUs. Many people are not building ADUs right now because the interest rates are high. When they take a HELOC, they have to pay really high interest rates, and the math doesn't make sense. It doesn't pencil out. So they decided to wait and to not invest in building an ADU right now. This is gonna be a game changer because the interest rates are gonna be down. They're gonna be low interest rates on your secondary mortgage if you are able to do it through Freddie Mac. Now there are, caveats and conditions, but we're not gonna get into the weeds of the conversation right now. But if you wanna keep stay updated on this very good proposal, if it gets approved, make sure you subscribe to my channel, and I will make sure to update to make an update on this when it gets approved. Okay? All right, guys. If you really liked what you have seen and watched so far, make sure you like and subscribe. Also share with friends and family so more people have access to information and we all have better personal financing and personal finances in general. Okay? Thank you, everyone, and I'll talk to you on the next one.